Please welcome James Kench to the stage. James is the head of insurance and leads the development of new insurance projects tailored to this rapidly evolving market at KITA. KITA is the carbon insurance specialist. Their mission is to de-risk high-quality carbon projects and enable them to scale. James, please take it away.
Thanks, Tim. Thanks for having us at this event. I mean, it's a fantastic event we're keen to support. So the purpose of this session was to give a brief overview on the carbon markets, to present some of the key risks for all the stakeholders involved and some of the emerging insurance products that can help to de-risk high quality projects. Just quickly about KITA, as Tim mentioned, we're an insurance firm. Our mission is to de-risk high quality carbon projects and enable them to scale. And we believe insurance is one of the keys to unlocking the institutional capital that the sector needs. So we're building bespoke insurance products and risk advisory services that solve some of the pain points as the market scales. And to do that, we look at the life cycle of a carbon credit and the risks over that life cycle, and I'll come into that in a bit. Look at the different stakeholders, so both the buy side, the sell side, the intermediaries, and how the insurance products could fit around those stakeholders. And then we look at all types of carbon projects, so both nature-based and engineered. And by carbon project, we mean anything that captures atmospheric carbon and stores it in some form. And I'm head of insurance at KITA, work with the team to build new products. And my background, just quickly, is sort of law, finance, and insurance, but always with a focus on emerging markets and emerging risks. So now just to kick off with some context on the market opportunity, we think it represents both a massive climate opportunity and an investment opportunity, but also comes with potentially uncapped liability for investors, corporates, and developers. And some folks think of carbon like a commodity, others like a security, but in either scenario, they both represent sort of assets and liabilities that would benefit from risk management and risk transfer solutions. And we think insurance has a key role to play in this market, as it can help add an extra layer of due diligence, and we're regulated capital. It can help unlock more institutional capital, add that risk management framework, but fundamentally act as a backstop if things do go wrong. So protecting both the downside risk for investors and corporates and allowing them to redeploy capital where it's needed. And therefore it can act like a stamp of confidence to enable folks to take action now. So we think both the carbon markets themselves and the role that insurance has to play is massive. And we'll dig into that. So just in terms of the market opportunity, obviously the priority is to reduce existing emissions as much as possible. The carbon markets are there to kind of channel financing to help remove those hard to abate emissions, both to reach net zero and also to help reverse climate change as well in the future. So the estimates are that the market could grow to potentially $1 trillion annual market by 2050. And the math to get there is that by 2050, we need to be removing 5 to 10 billion tons of carbon per year with a rough expected price of $100 per ton. And that gets to that sort of $1 trillion figure. And that's just an unprecedented scale up that would put kind of carbon on par with some of the global fossil fuel commodity industries as they are now. And again, all that investment requires, so it represents assets and liabilities in need of both traditional and bespoke insurance protection. So let's explore the profile of some of these markets, but just to explain briefly on KITA quickly. So we came through Lloyd's of London, have a innovation lab, and then we partner with some of the world's kind of global insurers and reinsurers. So that's great because we're a new firm, but we also have the AA credit rating of our capital partners and Lloyd's. We're FCA regulated in the UK, regulated at the state level in the US. And one of our USPs that we've built is the ability to pay insurance claims both in cash, but also in like-for-like carbon credits. So, and then before we dive into the risks of carbon, one thing to flag is that the role of insurance generally is there to help manage volatility. So when we see these high severity, low frequency events like hurricanes, floods, wildfires, etc., insurance is there, and our job is to assess and price the risks to investments and to projects, and that helps the stakeholders involved swap the uncertainty of what these future losses could be with the certainty of an upfront insurance premium, and that helps people not sit on the sidelines and actually take action now. So onto the risks for the carbon market. So a carbon credit is an intangible asset that represents 1 ton of carbon dioxide or equivalent that has been avoided reduced or removed. And as it's an intangible asset, in terms of the risks, there's a nuance between the physical risks of the underlying asset, the underlying project that's producing or capturing the carbon, and the risks to the credits themselves. Some overlap, some are specific, but insurance can take that into account. A bit like in the physical commodities market, oil firm has risks that are different to the buyer versus a trader of oil. The nuance here with carbon is that there's no physical delivery with oil. It's an intangible. So we see these 6 broad risk themes that I'll dig into, as well as reputational risk. But there's fundamentally these 2 dimensions behind it. The physical risks, which are probably fairly self-explanatory, and the insurance market is well experienced across these, natural catastrophe, supply chain risks, etc. It's the intangible assets which are quite unique to the carbon markets, new for insurance, and therefore requires quite a specific focus and understanding of the market dynamics in order to assess and price these new risks. How accurate is the carbon science on forecasted sequestration? Which methodologies have been employed? What is the risk that those may change in the future? And the forecast credits might be less than expected. How permanent is the storage of the carbon? Will credits be invalidated at some point in the future due to a change in rules or some sort of fraudulent event on the underlying project? So let's dig into how these risks may evolve over the life cycle of a credit itself. So in a credit, we see 3 main phases with 2 key milestones. So there's an early concept phase, scoping out the project, arranging financing, getting the approvals. Then there's an execution phase, the actual doing of the project, the capturing of the carbon. And then there's a retirement phase. And these are punctuated by validation and issuance. Validation is, if I'm a project developer looking to capture carbon in some form, maybe planting a new forest or building a biochar or a direct air capture facility, I have to apply to a third-party body to review what I'm doing. They'll assess and audit it, and then they'll validate the project. Then I have the sort of license to start carrying on with the project, but also being able to kind of pre-sell some of the credits I expect to issue. And then the issuance phase is, once that has been done, there's another round of inspection and audits to certify whether the expected carbon has been captured. And at that point, the credits will be issued, and then they can be used, i.e. retired, to be used as an offset as part of a net zero strategy. They can be sort of traded as well. So across those kind of key phases, we see these 6 risk themes, plus the reputational risk. Reputational risk is really quite a key one, and it's very pervasive. Companies want to do the right thing. They don't want their name to appear in the press for having invested in a project that has then failed. And I think a key challenge in the carbon markets, if folks are buying credits, then to some extent they are buying into risk, and you can't really insure a reputation directly, but we think insurance can act as that sort of extra layer of due diligence and stamp of quality that enables that investment, acts as that backstop, and therefore has a way to kind of safeguard corporates and investors who are taking the right approach. Beyond reputational risk, we think the majority of the risk at the moment is in that sort of pre-issuance phase, so from concept to execution, as well as the broader reversal risk once the credits have been issued. So one of the key things we've been focused on is non-delivery. So that is the risk that the credits expected or promised from a project are not delivered in part or in full. And insurance can help protect either the upfront investment or a pre-purchase of the credits against this if those expected deliveries don't come through. And then the insurance can make that party whole, either in cash or in like-for-like credits. There are price risks. Obviously, for companies that trade or invest in this market, prices are pretty turbulent. There's not much price transparency and quite big spreads out there at the market at the moment. And so for companies that are using those credits, that price risk poses quite a wider threat. And if a company is expecting to use credits but is forced to replace them due to, say, lack of delivery or invalidation, then it takes on quite a potential uncapped liability of having to replace those credits at what might be unknown future prices. Reversal risk, one I mentioned already, that's the risk that the carbon has been captured but might be re-released. This is most significant for sort of forestry and land use projects. So if carbon is stored in a forest and there's a wildfire, obviously that carbon is released. If carbon is injected underground via direct air capture and there's some sort of leakage later, then that's another risk. This is generally handled within the carbon markets by buffer pools, which act like a sort of mutual insurance scheme to protect against this. And the insurance industry, like ourselves, are working with those buffer pools, both to act as an advisor to assess what the contributions per project should be towards that buffer, as well as to build sort of insurance as a backstop around that buffer itself in case of depletion, either from one very large event or sort of a series accumulation of smaller events. Counterparty risk is a key risk as well, particularly given the voluntary nature or the non-regulated nature of the market at the moment. There's a large number of small companies that are operating in a wide range of jurisdictions, and a lack of standardization of the contracts and the regulation can exacerbate those risks. Invalidation is the risk that once the credit has been issued, that they might be perceived later to have been issued or executed in a sort of fraudulent or negligent way, and this could lead to those credits being deemed invalid. Political risk is quite a key one, particularly in the forestry space. A majority of the projects are in the global south, and there's a risk that a host country may alter its regulations impacting the carbon project, may prevent or cancel licenses to export those credits to overseas investors. And there the insurance market has a role to play. Political risk insurance has been around for a long while, and that can protect classic risks around nationalization or deprivation of an asset. But there's also folks like us that have been working on more nuanced political risk insurance around carbon specifically, and things around corresponding adjustments which could be issued to a particular credit. So those are the kind of key risk themes and the relative risk level over the life cycle of a credit. And I'll just show how we see the kind of key roles insurance can play for the different stakeholders, kind of building on from that. This is the last slide from me. Here we present the stakeholders and what the main insurable risks lie. I think the key message here is that there are a ton of risks for the stakeholders, but the insurance products are now available to de-risk them, and should be part of the toolkit for anyone deploying capital in this space. In terms of the stakeholders, obviously the buyers, the corporates that are ultimately going to be using these credits are key. There are also what we've loosely termed structurers. So these are sort of folks that are either investing in projects, lining up the corporates as off-takers, kind of structuring, arranging the project financing on these projects. There's the developers themselves actually doing the work. And then there's also a growing cadre of lenders that are coming in to help finance either the developers, the structurers, or the buyers. So it's an evolving space, but it's good to see all these players building out their approach. So in terms of the key insurable risks, so for us, the delivery is a key one, particularly pre-issuance, as I mentioned, and that's mainly focused on the buy side. So the end buyers, the corporates, or the folks structuring these project finance or sort of streaming type arrangements. There's credit insurance is available, so that's for the lenders entering this market. They're looking for non-payment insurance, i.e. they're lending to one of the stakeholders, they want that loan to be repaid. We think the main driver for non-payment in this space is still around non-delivery, i.e. If a project needs to repay its loan, it needs to finance that through the sale of its credits. If it is unable to deliver those credits, then it can't sell them, and therefore it'll be unable to repay its loan. Performance risk is a key one for the project developers. So this is around those unavoidable risks that could impact their ability to deliver. So particularly like natural catastrophe type risks, as well as some sort of political uncertainties as well. And then there's the political risks that I mentioned already, both these sort of traditional covers as well as specific to carbon. And then across that piece, there's that reversal risk, which currently, as I mentioned, is being handled by the buffer pools. There might be scope at some point in the future for folks that hold portfolios of credits or have retired portfolios of credits to be equally concerned about that, and whether the buffer pools are the right mechanism for that. We'll see how the market evolves, but we've been doing a lot of work with the carbon standards and the buffer pools themselves on this space, and we think it's sort of ripe for insurance to help contribute its view. So a key message there again, lots of stakeholders, but there's lots of risks, but lots of those risks are insurable, and the insurance market is really seeing carbon as a space where it could have both opportunity for profit, but also opportunity for impact. So that was a quick whistle-stop tour of the carbon markets and insurance, but very, very pleased to be here, and thanks for having me.
Thanks, James. It was very informative. You mentioned a lot of risks. What do you see as the greatest for carbon markets now and in the future?
Yeah, well, I think the key one that we've seen is that because the underlying asset is a physical one and it's so distributed, it's not like a software play where there's one firm that will sort of rule them all. It requires lots of on the ground, shovels in hand action, and most of the firms operating in this space are either early stage companies, newly formed or with limited track record, or they're operating in the sort of frontier of challenging overseas environments or new kind of challenging new technologies. So the key risk as we see it is the actual business risk to the project developers, that kind of credit risk or counterparty risk of those project developers, and being able to stay in business for the next few years as these markets scale. So that's how we've built most of our underwriting model around the sort of potential for default rates of these developers, which is unfortunately going to happen. But the majority will succeed. But.
Yeah, I can see that insurance is going to be a key part of the growth of carbon markets. Can you give us an example of how it's unlocking the markets today?
Yeah, sure. So I think the way we think about this, renewable energy project finance is a good example. So I think if there's any investment in a new project in that space, then you need to arrange your financing, but also insurance would just be par for the course. So I think having an established insurance market that is regulated and is willing to offer some risk transfer solutions to buy side, sell side, and really importantly to the banks as they get involved, then I think that adds that just kind of market maturity that the sector needs. So it kind of looks and feels a lot more like a true traditional investable kind of asset class. So I think that's one key step. And then also the upfront risk advisory, risk management approach. Risk is our business in insurance, and it's all we think about. So we're always keen to help share our 2 cents on a particular project or a particular investment, what we see those risks are, what are ways to mitigate, lower, manage those risks, and then what the price of insurance as an option could be as part of the deal or investment structure as well.
Great, thanks, James. I think we're gonna have to end it there. Thanks for sharing your perspective on insurance and how it can unlock carbon markets. Have a great day.
Thanks, Tim. Cheers.